Okay, what's up, everybody? So today we're going to talk about Upstart. Um, Someone on Twitter, Owen, if you're watching, this was actually inspired by you to make this video, was talking about Upstart. And then and a few other people actually, not soon after there, asked me what I thought about it, how to look at Upstart, what is it? So let's dive into some details here. But I want to throw this out there. First and foremost, I don't own this in any capacity. I'm not affiliated with them. I don't use them. I've never used them. I'm not part of the company. Nothing to do with it. These opinions are my own. The other thing I want to say is don't bother watching any more of this video if you're not going to watch predominantly most of the video, because it's all building towards a thesis here. And there's really no point getting 5 minutes of it if you're not going to listen to the whole thing. I'm not going to try to make this super long, but I just don't want you to waste your time for some big moment that's coming in the next 3 minutes, because it's not. We're building into it from data and information. So I know this is a weird thing to say at the beginning of a video, but I would hate to think that like you're going to miss the point of the whole thing. So sorry if that's weird to share that, but I don't want to waste time. So I'm going to jump right into sharing my screen. I want to get into this as quick as possible because I think there's a good amount of stuff to cover here. So you should be seeing my screen. And originally, here's how it got started. Some folks were asking me about UPST. I hadn't really been too sure what it was or what the deal was. Once I jumped in, I quickly understood, very quickly actually, what I was dealing with here. So per the piece on the right-hand side, Upstart is an AI lending platform that partners with banks and credit unions to provide consumer loans using non-traditional variables such as education and employment to predict creditworthiness. According to this, they have revenue of $233.4 million at the end of 2020. We'll get into those actual most recent updates in a second here. I'm going to run through the investor deck. I want to run through some interesting things. And I also want to talk to what I think about the company and the way they go to market as well, because I think it's really important, both from not only a stock perspective, a growth perspective, but really like, haven't we seen this before? Why does this seem to keep coming up more and more? So right off the bat, when I quickly looked at the price, you can see here that, they've been down quite a bit, right? Even as I go to the 5-day, I go to the 1 month, I go to the 6 months. I mean, this is pretty ugly. We saw an all-time peak of 390, and pretty much right now we're sitting at about 100. So, almost down 75% or so from that high. Not great. Probably a lot of reasons for that. We're going to dig in and find out. But I wanted to call out also is they've got a market cap. Let's just give you the most recent market cap here of 8.41 billion. I mean, for a website that, per what I'm seeing here, simply connects people looking for money with banks and credit unions willing to give that money out. Now, their whole pitch, as I understand it, is this is based on AI algorithms to talk about how to give people loans who are non-traditional buyers and yada, yada, yada. And what I'm seeing more and more is this AI, right? Saying AI in front of anything almost lets companies get away with things like what I consider stupidity, frankly. So in essence, what these folks are is they are simply a middleman who most likely charge an origination fee and then get the money from a couple of specific banks. Now, they're making it sound like there's tons of banking partners. Anyone who wants to be on this program can leverage their technology to do so. And I'm going to talk about that in a second, but I want to share it. So this is the main website. I think it's really important before you do anything here to understand what it is, right? So essentially, if you're a borrower, there are some different things you can borrow: personal loans, refinancing your car, credit card consolidations, home improvement loans, etc. If you're a lender, I don't get a list. I just click on it. It's going to basically say to me like, hey, can I get some more info about having this work with my bank, right? 75% fewer defaults at a similar approval rating, 5 times more predictive than credit score during COVID-19, and an NPS score, which is equivalent to really a customer satisfaction score of 82, which is much higher than a standard place. So I just want to call that out. They talk about why this is so good for the banks, yada, yada, yada. I don't really think there's a need to go too into details here, but I want to call this out just to be fair. Like, this is basically done for both banks and for consumers. And then there's dealers as well. They can sort of work as middlemen as well sometimes. But what I really want to point out here was when I think about why a bank would need AI to help with their funding, it's for 2 reasons: to be faster and more automated so that there's less human touch needed. So essentially what I would do is I would set up parameters of what are acceptable things to automatically say yes or underwrite a loan. And if someone falls within those parameters, we can say yes. Now, the key though that makes this a little bit tricky is when I went through the entire deck from their last investor presentation, I couldn't find a single reference, the entire deck, what they were charging for interest rates. That's a big, big, big warning sign. I was a very early investor and a very early participant in person-to-person lending via things like Prosper and Lending Club when they first came out, because I thought the idea was great. Normal people need money to get themselves in good shape. I became a very early lender on those platforms. And what we came to see was massive amounts of defaults. And the reason was because essentially the only way you could make decent money by lending it out was at high interest rates. And the people who were getting the high interest rates were the ones who were deemed to have sort of the toughest credit, lowest credit score, et cetera. Now, I'm going to talk about this in a second in regards to what Upstart's claiming here, but I'm going to point out something that's very interesting. So typically you get into credit card debt for lots of different reasons, right? Sometimes it's good, sometimes it's bad, but oftentimes it's just because it happens. You have more bills come up, you're not prepared for them, things are going, you lose your job, COVID hits, you get sick. There's a million reasons why you could fall behind, but a lot of times it's nothing to do with you. It just is what it is. So, you know, a lot of folks think like, I'll tell you what I'm going to do. I'm going to go out and I'm going to borrow some money. I'm going to pay off my credit cards. And the idea behind it is a consolidation loan takes all of your credit card debts. I'm only using this as an example. There's lots of different things, but you take all of those debts, you put them together, and you have one monthly payment. And then that monthly payment means at the end of it, you will have no more credit card debt because you've paid it off with the loan. You'll have no more loan at the end of the term because you've paid off the loan. The problem, though, in my experience, is that if you're having issues paying things for cash in the first place, consolidating your credit cards onto a loan, oftentimes I think people end up still using those credit cards after because things keep on happening in life. And simply having a loan means now we have more access to credit on those cards again. That's not a carte blanche statement, but I do want to call it out that if this loan was very low interest, it makes tons of sense actually. If you're providing a service where I can consolidate high interest debt into low interest, predictable loans, that's sort of a no-brainer. I get that 100%. But again, I couldn't find a single reference on their earnings report of what people were actually paying. And it's really interesting because through all of this, it seems like these are the things that should be really obvious to anyone. Now, I can obviously go in here and do things like check your rate. Essentially what happens, it's almost like a soft credit score. They don't actually pull your credit so it doesn't show up as a true credit score. They give you a rough idea of what your rate will be, what your cost will be, et cetera. Anyone can do this. And again, I'm not suggesting you do this, but just full transparency, it's not like they're hiding these things, which I think is great. You can borrow anywhere from $1,000 to $50,000. $50,000 is a lot of money, especially with a short-term term, like 5 years. If you think about that, that means before interest, if you have a $50,000 loan, you're paying $10,000 a year back before interest. So you have to ask yourself, like, that's going to be close to $1,000 or much more than $1,000 a month. Do you have that, and does that really solve for your problem of paying off those credit cards, right? And again, look at this, 3 to 5 year terms. So, I mean, these are pretty big payments. These are like mortgage payments for a small home. And then of course, here's the real joke. I'm not calling these folks out specifically because I think everyone in this space does the same shady thing. These personal loans that we get letters for every day, emails about, ads all over the place, they always say things like, oh, 3% to 36%. That's an unbelievably outrageous range. I mean, that's absurd. That's absurd because the folks who are borrowing money at 3% would have to have such unbelievable metrics about their personal financial situation that they're not going to be borrowing money from a place like this anyways. They're going to have access to capital largely in the first place, probably not maxing out their cards. They wouldn't get that much of a rate anyways. So sort of just absurd to me. But the one thing I still was looking for was like, what are the actual rates? And this is where I finally started to come across them. This is sort of a funny thing. So the full range, this is down here in the little section where you got to really go and read the details. The full range of available rates varies by state. The average 5-year loan offered across all lenders using the platform will have an APR of about 24% and 60-month payments of $25.88 per 1,000. Okay, I can do this in my head, but I'm going to do it on a calculator just to make my point here. Let's just say we borrow, forget about the 50K, let's say 25K, right? So that's 25 increments of 1,000 times 25.88 per, you're paying $647 a month. That's a lot of money. That's a lot of money for a lot of people. That's a car payment. That might be half your mortgage, depending on where you live. That could be a huge piece of your rent. It's a lot of money. So as we read further here, for example, the total cost of a $10,000 loan when all said and done after the term would be $15,526. So to pay off that $10,000 in debt, you're actually paying $15,526, which also includes an origination fee of $644. Now, one thing I will say is there's no prepayment penalty and no down payment, which why would there be in the first place? I guess that's a hard money loan essentially, so that seems absurd. But there's no prepayment penalty, which is good because really I hope you're not paying all this interest anyways, and you should try to pay it off. But I want to call this out before I jump into the weeds that for anyone who says to me that this is based on AI and all these special factors, this is absolutely no different for the borrower from anything else. That's an outrageously high interest rate. If the average on the site is almost 24%, that is absolutely insane. I'm sorry, I got to say what it is. That is insane. And although we may not be seeing large defaults at this point, it's hard to believe that a lot of people can maintain this kind of a payment over a long-term period. And this is what happened back 15 years ago with Lending Club and Prosper, was what started off with as 24% returns sounded great to the investors. Like, oh, I'd love to make 24% on my money. But guess what? You never got any of your money back. Everyone defaulted. Now, I know that they're making claims here that that's not happening. That's not an issue. All this great stuff. But you're going to see some metrics in a few seconds here that are going to make you say like, well, wait a minute. That doesn't tie up with this idea of all of these banks and this huge access to capital. So we'll get there in a second. So as usual, what I did is I wanted to see the actual material here. So down at the bottom of the standard site is investor relations. I clicked on investor relations and I navigated to news and events and presentations. This brings me to their most recent earnings presentation, which I'm going to share right here. I will say one thing as a positive. I love when publicly traded companies put together nice investor presentations, not just copies of their financials. I think it's hard for a lot of people to read and understand. So I do give credit where it's due. Now, what I want to call out here, this is a stock that's down some 75% from its all-time high currently. It got pounded just the other day again. They're offering loans at insane interest rates. I'm sorry, I don't care who hears it. Insane to charge anyone 24% for a loan. That to me, the fact that that's not criminal, I actually can hardly believe it in my mind, but that's a horse of another color for the moment. So this is the Q4 and full 21 earnings. This came out on the 15th of February. Now, again, I'm going to be very clear. I have no affiliation whatsoever with this company. This is 100% their material. I'm simply giving you my take on it. You should make absolutely no investment decisions whatsoever unless you read every single page of this yourself, understand exactly what the risks and opportunities are, and understand that this thing could get much worse or it could get better. I don't know. I'm simply giving you my take on the earnings. So here is their mission, and I want to explain why I think this is a joke. Their mission is to enable effortless credit based on true risk. Now, here's the thing. This is what they're defining as this situation. They're leveraging a number of AI models. I don't, excuse me, I don't know what models they're using, although I can take a lot of guesses and probably be pretty accurate on it. They're calling themselves an AI lending platform, partnering with banks to improve access to affordable credit. That's a complete joke, affordable. I'm sorry. That's absolutely unbelievable, but fine. So their idea of this AI-based platform is because it looks at employment history. So do regular reports. They look at credit experience. So do regular reports. They look at education. Well, most banks and lenders do ask for information in and around that anyways. They look for application interactions. Let me be very clear on this. That can mean lots of different things. It could mean that how many times I log in and check. It could be, do I check myself to see what my rate is beforehand? It could be, how often do I follow up and how quick do I answer the questions that you need that are outlying? I don't know because they don't call it out, but that's my assumption. They look at things like cost of living. Well, yes, everyone looks at debt to income for any kind of a loan. I'm still not hearing AI here. And they also look at your bank transactions, which to me means now they want to see, this is really a fancy way of saying, I want to see copies of your bank statements, which again, can anyone help me understand what the AI is here? What this sounds like to me is an if and or then process based system where if it's, plus 2 years of employment over this DTI with this kind of a background and this, offer this credit rate for this dollar amount and automatically approve. In theory, you could call that AI because it will automatically give you a yes or a no. But I'm willing to really bet if I rip this thing apart, I'm going to find that it's largely process-based and not true AI. And they're calling it AI because it's probably learning from the data. So in that sense, sure, maybe it is, but it's not really in the way that I think it's trying to be portrayed. Like, to call what a regular credit application would be AI simply because you're saying the word AI, I don't know. But let's read it, right? Leading AI platform with scale, rapid growth, and profits. Two-sided business connects consumers to AI. We already know all that. Growth is driven by continual improvements of the AI model. This is very simple. This is just AI learns from data. If a whole bunch of people default, they're going to look for the commonalities and what those defaults were and start applying different weightings somewhere else in the process. So maybe it's harder to get to a yes than a no. But again, I don't know that this is much different than what a regular bank does anyways. 70% of loans are instantly approved and fully automated. They actually go on to say here later on that fully automated means that no one ever has to actually be involved. It just gets a yes automatically in the system. But what I want to explain here again is, if you charge a high enough interest rate that you can define essentially what you're trying to define is your risk of default and your potential ROI on that loan, understanding how many of them are likely to be default, and then find the profit point that you're looking for. It's just, hey, with this risk factor, offer 28% and we'll agree to it. And then someone who's obviously on here who needs this money is like, well, I need the money. I don't know, is 28% a lot? And they say yes. I don't know that that's a great thing or not. 94% of revenue, fees from banks are servicing with no credit exposure, and then GAAP net income is profitable. We'll see. So that's the take here. Here's sort of the big piece of it. For consumers, higher approval rates and lower APRs. Man, I'll tell you what, if the average on the site is 25, 26%, whatever that number was, I would really be interested to see what that's based on, because I understand there's a lot of credit card debt out there that is pretty bad, but like they're talking about also car loans and all kinds of things. I mean, I actually just got a car loan recently. It was like in the twos. My mortgage is in the twos. So I don't know what the situation is where someone has interest rates over 24%. And what I would say is they're likely getting ripped off already. This barely makes a dent in that and simply just creates a massive monthly payment that I think would be very difficult to pay anyways. 70% are instantly approved, no document uploads, calls, or waiting. It's more inclusive, according to this, because improved credit access for all demographics tested. I mean, I don't want to be overly negative here, and I think that's probably the way I'm coming across here, but essentially looking at all demographics, meaning that like no matter the color of your skin, your background, ethnicity, whatever, everyone's simply paying 24%, 25% on average. Yeah, I guess that's more diverse, but that's also more people getting hammered with high interest rates. From the bank's perspective, this is great, right? It's highly automated. It's all digital. They customize to the bank's credit policies and risk appetite. Again, like I said earlier, is this really true AI? Or is it just the bank says, hey, if they have a 10% default rate, I want to charge 29% and only offer this much money and only for this amount of term? I mean, that's not AI in the true sense of the word of it. And it's more inclusive and profitable lending programs. Whew, man, I don't know. This feels exactly like a payday loan, but someone stamped the word AI on it. And you see these sort of stories. I'm not even going to draw attention to it. So here's the interesting thing, right? They're looking at the annual loan origination TAM, which is total addressable market for consumers, of mortgages of 4.61 trillion, autos of 727 billion, and personal loans of 96 billion. Cool. So it's a huge market for lending. I get all that. I guess the problem is, like, they're not in the business of earning the interest on these loans. They're in the business of charging origination fees for these loans. So, it's interesting how these numbers come to be, like revenue versus net earnings, et cetera. And even from their business perspective, small businesses are borrowing in the neighborhood of 644 billion, which is, to be expected as well. I want to call out too, though, you can go right now and get like an SBA loan, a small business. Oh gosh, I forget what it's called now. Someone can correct me in the comments, please. I think it's SBA, but they do rapid loans, for example, that can be turned around in like 24 hours for a small business, up to I want to say $40,000, but it's been years since I've looked into it. Pretty reasonable ability to get approved for those, and those rates are not even in this kind of neighborhood. I still am blown away by that rate. So here's some key financial highlights from Q4. Look, revenue is way up. Obviously, income from operations is way up. Contribution profit. That's an interesting one. I might have to actually Google that because contribution profit. Contribution margin is computed at the selling price per unit minus the variable cost per unit, also known. Okay, so they're just calling it a different name. Interesting. Okay. Good to be aware of, though. So, like, look, here's some crazy numbers. I mean, revenue is up 252%. Income from ops is up 481%. Contribution profit is up 261%, represents 52% of fee revenue. Net income is up, holy moly, over 5,600%. Adjusted EBITDA, wow, these are some wild numbers. I mean, these are really good numbers. I'm actually not sure what happened or why the stock fell. I'm gonna have to look into that. The full year revenue highlights: revenue is up 264%. Income from ops up over 1,000%. Contribution up over 279%. Net income, wow, these numbers are insane. Wow, I mean, these are huge, huge numbers. This from the automotive perspective, they're expecting 1.5 billion in full year 22. They've tripled their dealership footprint, grown 41% quarter on quarter. Auto refi funnel performance is now comparable to personal loan. Okay, so here's sort of the big takeaway, I guess, in general is from the automotive perspective, they're seeing huge amount of growth here. More and more dealers are starting to want to work with them. They currently have 10 banks, though. That's not really, to me, that big of a deal, but 10 banks have partnered with them for auto lending. I was actually just talking to a guy who works in auto finance the other day because I literally just financed a car. And I was asking him, I said, how hard is this in 2022? This is before I even looked into any of this stuff, by the way, so this is really funny timing. And he said, well, for the most part, it really depends. He's like, you get great credit, good income. With vehicle prices going through the roof, it's very easy to get things approved right now. And he said a lot of it's just automated, right? It's essentially a marketplace. We put in all your details. It comes back. You get it. Boom, boom, boom. See you later. You have your car loan. I don't see anything in here, by the way. I want to call this out again. Anywhere where they're talking about rates. I don't know if anyone else has noticed that, but there's been nothing in here about rates. So keep that in mind, okay? And you can see here too, like, they're growing their dealers big time, which is good for them. Like if you're an investor, I don't think there's necessarily anything in here that stands out as being negative. I would say almost contrary. This is like an unbelievable earnings report. Looking at these numbers, the growth rates, the year-over-year rates, absolutely insane. I just think it comes back to the fact that nowhere in the investor deck does it talk about what they're actually charging people and how does a normal functioning person continue to pay 24, 25%. I mean, we're talking like getting out of debt by taking on a massive monthly payment. Think about that. Think about that for a second, how wild that is. And you'll hear anecdotal stories of like, wow, this new payment is so much less than the payment I already had. I don't know. I mean, minimum payments on credit cards might get high, but fixed loans, of course, are going to have higher monthly payments. So sometimes you see stories like that. It's hard to tell like who was in the situation, what's it look like. So I want to call out here that all the data is in here from the numbers perspective. I would urge you on some of these to actually like, oh, look at that now. Earlier, a lot of these, I don't know. I don't like some of the way this is presented here. Everyone can have their own opinion of that, of course. And I'm not even necessarily saying anything is wrong here. Just some of these things are very interesting. It almost makes it hard to tell. It makes it almost hard to tell what they're holding, what they're not holding, and what's revenue versus what's their actual profit here. It should be very simple, right? I just want to see somewhere where is this what they're generating from origination fees right? Or is it not? I can't seem to really tell, right? It's hard to get a feel for it. Like these returns year over year are so insanely huge. It's hard to get my arms around like what the heck has happened in the business and why is everything so profitable? Why is everything so good? Why is everything so amazing? Like this, there's nothing negative on here except for the fact that people are getting jammed up on their rates. I mean, look at this. Holy moly. These are insanely good numbers. Wow. And then there's some other good stuff in here. I didn't really want to go too crazy and go to all the details here. Um, but even like looking at this, like, right, like from a fully automated perspective, I think I mentioned this earlier, 70% of the loans were fully automated and instantly approved in Q4 21, while fraud rates remained minimal. So my main fear is as they're ramping up like crazy, and you can see this growth has been wild growth. Is fraud a constant or is it linear? Like, is it linear or do we see asymmetric growth with that? And additionally, forgetting about fraud, people who just aren't able to pay, who end up defaulting, I don't think you see that happening in the first 6 months or year. I think probably a lot of folks who are borrowing here end up getting hammered by these monthly payments. And at some point, probably, I think what we're going to see is you're going to see some more problems there. But again, if you notice though, what's missing here is I'm not seeing any information at all about loan defaults, right? Anyone else noticing that as well? I mean, let me just do a quick look here. I'm not seeing it. I don't know. I mean, if it's in here, it's somewhere where I'm not finding it. Let me see. Okay, so they're holding some loans. So that's interesting. So they are investing in some of them, not just with banks. Okay. Boy, oh boy, I don't know. I am not seeing anything here about defaults, what those rates are. Let's just do a quick peek here again here. Hmm. Let me see. Real way down here in little writing here, right? Borrower acquisition costs were 32.2 million and 103.5 million for 3 months ended December 31st. Borrower and verification servicing costs were 10.8 million, 34, blah blah blah. I don't know. The things that I really need to see in here, I'm not seeing. Let's see. Sorry for the lack of sort of insight here, but like I really can't find what okay, that's it. So listen, here's the deal. I'm not saying whether this is a good or bad investment. I never do that on these videos. What I want to do is provide clarity in what I see about the business model, the operating model, the numbers, the way they're presented. What stands out to me is we have a stock that's been absolutely hammered from all-time highs to almost all-time lows. Who is blowing the numbers completely out of the water, like crushing earnings, by offering unbelievably high-priced loans, like unbelievably high-priced loans to people who are in real need of money or capital. And for me, there's an ethical concern here, but even more so than that, there's also the standpoint of like when does the house of cards potentially fall? Maybe never. Maybe the reason they don't call out defaults is maybe they don't have a problem there. I don't know because I can't verify it because it's not in their documentation that I'm looking at. If it's somewhere, please let me know. I would actually really like to see it. But it's concerning to say the least. I think that's probably where my head is at really is like, I definitely am trying to figure out, I'm trying to figure out what I'm missing when I see such unbelievable numbers on every single page that I look at. We understand fraud is seemingly completely under control, but if you're telling me you're using AI to look at a borrower's true ability to be worthy of getting a loan, but still being charged that much, I don't know that I understand exactly what the difference is, especially then if the banks can simply move the parameters wherever they want, then it's hardly based on AI. It's really just a process-based system being attributed to AI, right? Like the simple way to think about it is if one bank says, I need a credit score of 600, another says 620, and the AI, all it does is represent that someone is over that number and should get a yes. I guess that's automated, but isn't that more of a process than an AI functionality? Now, granted, the AI can learn from the data, but if the AI is not the one making the recommendations are coming from the banks moving their own numbers around, that gets confusing as well. So that's one of those things where like I stand back and I'm sort of like, I don't know what the right thing is or how to position it here. And so that for me is the entire structured issue with what I'm looking at is the information I really need, like how many people are defaulting, what does the actual profile look like? How many people are getting like an A, a B, a C, a D, E, F rating? What are they paying individually? As well as how many people are paying that 3% interest rate? And how many people are paying that 30% interest rate? And what is the difference in default rates and fraud at those different rates? None of that was in there. That is the stuff you have to ask for when you're investing in a company, not the good stuff, right? A company that gives out loans is hugely risky as an investor because everything hinges on them getting paid back for those loans, especially if they hold them on the books or if it's just getting fees for originating them. So I guess I'll leave it with this. I would urge anyone who's looking at this to really double down on due diligence and ask yourself, what happens if? What happens if 10% of their borrowers at the top of those interest rates can't pay? How much does that affect all those other numbers? And how do they continuously and constantly keep finding more and more people to take out loans? There is a question of serviceable market. Everyone talks about TAM, which is total addressable market, but they don't talk about SAM, which is the serviceable addressable market. That's the part of the TAM that you actually could go over. You could actually get as a business. So now when you drill down from TAM to SAM, within that SAM, how many people are going to be able to pay you enough in interest and fees to make it worth your while? How many are going to be fraud? How many can be defaulted, right? You end up with a pretty small number that has to drive your entire business. And, one blip, one big layoff, one big problem with the economy, which we're surrounded by lately. But you get my point, right? Like there's a lot of risks in here that stretch the realm of ethical interest rates to not knowing how people are paying these things off, to having no true feedback on what those numbers look like. So the other piece as well is at some point, your customer acquisition costs for these kind of products stop scaling because as you have already sent out the same mailer to so many people now and you haven't gotten them to come over to you yet, is it because they're going with a different bank, a different solution, someone else is offering a better rate? Do you even know? Who's to say? So I guess what I would sum this up as very simply is this doesn't feel right to me as an investment that I would take. That's not a recommendation by any stretch of the word. It just simply, for me, I don't like the model. It doesn't feel right to me. It feels like there's a million other competitors who could be in this space. In fact, frankly, I think that probably if you're watching this, you, me, and a couple other people could probably put some money together and do the same thing because heck, at a 24% interest rate, your returns are going to be so insane based on what we're seeing on here. We're all going to have billions of dollars at the end of it, right? So it gets pretty wild when you look at those rates and you look at the growth. And then you say to yourself, well, why isn't every bank on the planet doing this? And that's the real question. And a question I don't have an answer to by looking at their numbers or the website or other information. Now, I'm sure that I could request that, and I'm sure that they would answer. It's certainly a reputable company, reputable publicly traded company. I just wonder why I can't find it easily, and it's not in the presentation that only paints to all of the wonderful things that are happening. So with that, I hope you enjoyed this. If you're thinking about investing here, certainly don't take my word for it. Just make sure you do the research on it and look at the numbers and make sure they fit your profile of what you're looking to have. And with that, hey, thanks for watching. Appreciate it. Have a good one. Thanks, everybody.